Here is your lesson for 7.3, adjusting and closing entries. And if you're following me on the textbook, it's page 230 to 246. The things we'll cover today is preparing closing entries using the worksheet and explaining how these entries update the capital account, describe how closing entries prepare revenue and expense accounts for the next accounting period, and explain why assets, liabilities, and capital accounts aren't closed from one month to the next. And at the very end, we will prepare a post-closing trial balance to check our accuracy. So our adjusting entries we've already covered in a worksheet. Now all we need to do is to transfer them. So if you look at this one, here's the supplies expense debit of 100 and supplies credit of 100. Okay. Okay, so we need to make sure that we are going to be adjusting these entries that we've journalized and posting them to the ledger. You will notice that some of them don't have a balance because from one month to the next, the balance is going to be a 0. Okay, so in the blue, these are the adjustments that we are putting in. So at the end, that's our balance. Okay, introduction to closing the books. The income statement shows the net income or net loss for a specific accounting period. The data required to determine the net income or net loss is found in the revenue and expense accounts. The revenue expense accounts are reduced to 0 by a process called closing the books. Every month, we want to have 0 in those accounts so that every month you can know exactly what you're spending on revenue and what you have in expenses. The ones that we need to close are called temporary accounts. The ones like assets, liabilities, and owner's equity are called permanent because you don't turn those into a 0. Okay, so the reason why we're closing the books, I kind of talked a little bit about this, is because at the beginning of every month you want these to be 0, so you know specifically every month what you have for revenue, what you've spent on expenses, and it allows you to really understand where your company is doing well and maybe where you need to make some adjustments. Okay, so we have something called the income summary account, and what this account does is when we're closing our revenue and expenses, we can't just throw out the revenue and the expenses. We need to transfer it into our income summary. That means we're going to take our income and we're going to summarize it in this account. So you have expenses and you have revenue. The total for the expenses is going to go into the debit side and the revenue is going to go into the credit side. Okay, so we have some steps here. The first thing we need to do is we close our revenue accounts. You might want to write that down into your books. So we have sales credit here. So to close it, we need to have a debit. And we're not just throwing it out, we're transferring it to our income summary with a credit. So do you see how this is a credit here? So we need to transfer it into the credit, and it's being transferred into the income summary. This transaction right here is used to close the sales account. Okay, so it looks like that. Step number 2 is we need to close our expense account. So if we have a debit of $6,300, we're going to close it with a credit to utilities expense. And we are going to transfer it with a debit to our income summary. And it looks like this below. Okay, and we can do this all in one transaction. We can close all of the expense accounts and move the total in one transaction into the income summary. Instead of doing salaries, then income summary, utilities, income summary, we can do it all at once. Step number 3, we need to close the income summary account and transfer that to the capital account. So if we look here, we have a debit and we have a credit, giving us a credit balance. We want to close the income summary, and we want to transfer this credit to the capital. Our company is now worth more, $51,140,000 more. Okay, and it's going to look like that. And that's an increase. The last thing we need to do is close our drawing accounts. So we have $42,000 in drawings. So we are going to close that with a credit, and we're going to transfer it to the capital there with a debit because it brings down. So at the end of everything, our capital is $57,840. Okay, so your summary looks like this. This is your 4 steps right here. This might be a little bit hard to follow, but that's basically what we're doing in all 4 of those steps I already showed you. And the last thing we need to do is to close the books from the worksheet. And you should just make sure that your revenue and your expense accounts are now 0 and your capital account has been updated, so it's ready to go for the next month. Okay, so we need to post that now. Fees earned, income summary. Closing expenses look like that. We've updated the owner's equity. We've closed the drawing. Now when we do our post-closing trial balance, you'll notice here the only thing we have left are assets, liabilities, and owner's equity. Our revenue is gone, our income summary account is gone, and all of our expenses are gone. And what happens when we have a net loss? The opposite happens. You do the same steps, but now your revenue is actually going to be going down, and so is your capital. Okay, so you'll see here the owner's capital has been decreased from 100,000 to 97,200. Okay, so now if we look at the accounting cycle, you will notice that we've just added a little bit onto here. If you go to here, we have our adjusting and closing entries into our ledger. We've done a post-closing trial balance, and now we're ready to start the whole thing all over again. Okay, so those are the kind of the standards and key concepts that we covered. Hope that this has helped you.